guys, welcome back to my channel. In today's video, I'm going to talk about two of the other Greeks. So in a couple of previous videos, I talked about options theta and time decay and how it could potentially affect your premium and your options contract in general. Today, I'm going to talk about delta and gamma and how they affect one another, as well as how they could potentially affect your premium price, how your options contract plays out, your overall position, and so on and so forth. So as we go through it, I did create a little PowerPoint for you guys to kind of run through. I think it's easier to see visually what I'm talking about while I'm talking instead of me just rambling on for you guys. So yeah, that being said, don't forget to hit that like button and subscribe to my channel for more content. And if you have any video suggestions, go ahead and comment down below. And yeah, let's get started. Alright guys, so let's just get into it. Like I said, I'm going to be talking about the two Greeks, the delta and the gamma, how they're related, and then how they could potentially affect your options premium. What we have here is your options delta. So the delta is a measure defined as the measure of how much an options price is expected to increase or change per $1 change in the price of the underlying security. So what this means in layman's terms is for every dollar that the stock moves up or down, your options delta is going to signify how much your contract premium moves up or down. So for example, if you have a premium of, a delta of 0.5, and the premium you paid was, let's say, $3, and then the price of the stock, let's say, is $200, and you buy calls, okay, for $3 a piece. The $200 goes to 201, so the stock moves up $1 to 201, okay, increases $1. This means that this premium price is going to increase by 50 cents. So your premium should, in terms, turn to $3.50. So this is with everything else constant. Your premium price should move to $3.50 with a 0.5 delta on that premium, on that contract. So this is not taking into consideration theta, expiration, none of that stuff. So this is just delta itself and how delta affects your premium price. So that being said, let's go into some other things. So call options have a positive delta and they can range from 0.0 to 1. At the money options are going to have a delta near 0.5, and the delta is going to increase as the options gets deeper into the money. So as your options contract gets deeper in the money, that delta will get closer and closer to 1. So another way to kind of look at delta is probability. So what this means is if your contract has a delta of 0.5, people sometimes say, you know, my contract has a delta of 50. What this means is they're talking in probability terms. So what it means is that they have a 50% chance of their options contract moving into the money. So that's sometimes what people look at delta as well, is the probability of your contract moving in the money. That's another way to look at it. Your put options are going to have a negative delta that are going to range from 0.0 to -1. At the money options are going to have a delta near -0.5, yes. And then the delta is going to decrease as the option gets deeper into the money. So how the put side works is the same way. So let's say you have an options delta of 0.5, okay, you paid $3 per premium. The stock is currently at $400. Okay, and you bought puts. The stock drops to let's say 98. So the stock drops $2. Okay. What this means, so the delta is a change in every dollar of the stock. So that means potentially your premium price is going to move to $4. Okay. Because it's the 0.5, so 50 cents, times the $2 that it moved, increase of $1. So as a general rule of thumb, you should understand that in the money options are going to move more. The delta is going to move more than out of the money options, and shorter term expirations are going to move more than longer term expirations. So they're going to have more of a fluctuation in the delta with the same price change in the underlying stock, it just is because one may be shorter term, one may be longer term, one may be in the money, and one may be out of the money. So in the money is going to move more, out of the money is going to move less. Shorter term is going to react more than longer term price changes. Obviously, if you have a longer term expiration, your contract premium is not going to fluctuate as much to volatility in the stock as if you were trading, for 1 week expiration or 2 week expiration versus a month or 2 month out expiration. So as your expiration gets closer and closer, the delta of in the money contracts is going to move closer to 1 until you finally get a 1-to-1 reaction from the stock price to your options price. That's why your in the money contracts gain more as they continue to move further into the money versus your out of the money contracts or even at the money contracts, because that delta is at its highest point. So even if you think about it probability wise, because out of the money contracts have a lower delta, it's going to have a lower probability of it going into the money. Not saying that it could not go into the money, but it's going to have a lower probability as further out that you get on the strike price. The further out of the money you buy the strike price, the less probability, the lower the delta, and so on and so forth. I'll talk about the gamma and how the gamma affects your options contract and how it correlates to the delta. So basically, the gamma measures the rate that the delta is going to change at. The further out your expiration, the lower your gamma risk. Like I said, the further out your expiration, you're buying yourself not only more time, you're buying yourself less volatility when it comes to the gamma and the delta. So your contract is not going to be prone to the volatility that the stock is going to be prone to. Now, so again, you can see right here, the option is less sensitive to price swings with more time to expiration. So the higher your gamma is going to signify that the delta is going to be more sensitive to price movements in the underlying stock. So the higher the gamma, the more volatile your delta could potentially be, especially if the stock is volatile as well. Like I said, if your gamma is very high, it could potentially create more volatility in your premium price, because then the delta signifies that the delta is more sensitive to price swings. Again, I just want to reiterate, the delta and the gamma are not linear. It's influenced by multiple other factors: time to expiration, the stock's volatility, implied volatility, time. There's just so much that goes into it. The strike price, whether it's at the money or in the money. You want to understand how each one of the Greeks can potentially affect your contract price, and therefore affect, especially if you're swinging your contracts, even if you're scalping or day trading, how they could potentially affect how your contract price moves and how you end up getting paid out on that contract. So if you look at it in another way, so say you're looking at delta as a probability, the gamma can also measure the sensitivity of the delta. So if you look at gamma as kind of the stability of the delta, so how stable is the probability that that stock will go, or that contract will move into the money. If the gamma is very high, that probability percentage could not be as stable, because that delta is going to be a lot more sensitive to changes in the underlying stock because your gamma is high. Now let's go ahead and look at these on the options chain. So I'm going to increase this a little bit. So here is Nvidia's options chain here, and the delta and the gamma. So I just want to let you guys know a couple of things that I may not have mentioned. So the gamma on at the money strikes is going to be the highest. The reason for that is that any potential move in the underlying stock can push that contract into the money or out of the money. So that makes them the most sensitive to the delta movement and to the underlying stock movement, which makes the gamma the highest. Deep in the money options are already going to have a delta that's close to 1 or right at 1 or -1, depending if it's a call or a put. So the gamma is less prominent, which is why gamma is higher at the money versus in the money or out of the money contracts. So you can see here on Nvidia that most of the in the money contracts are at that 1 delta, and the gamma is pretty much at 0, because these are less sensitive to price changes in the underlying stock. Versus as you move down, you can see that the gamma starts to increase, especially at the money. We can see that the at the money strikes have the highest gamma. We can see that at the money is closest to that 0.5, which is going to give you that 50% probability that it could go in the money or out of the money, because at the money is the safest strike to select, especially when you're scalping or day trading, because you're going to have the highest probability chance that those stocks are going to go into the money. So the further out of the money you select your strike price, the less change you're going to see in that premium. The premium's not going to move as fast as if you were to buy an at the money or in the money contract. So for example, say you're trading a stock on a Thursday or Friday. So remember, theta is the highest on Thursday and Fridays because it's the closest to expiration. And say it's the same week expiration that you're trading, you're scalping. We just saw that out of the money delta options are, the out of the money strikes have lower deltas, higher theta. So what this means is if you trade an out of the money contract closer to the end of the week and you're scalping, what can happen is as the stock makes a move up, say you want to enter on this trade here. When you enter, let's say the stock pulls back, okay, it retests. What could happen is that you could lose potentially a lot of value on your contract here because the theta is the highest at that point. So you're going to lose more time value on the stock. So when the stock and the delta is lower and out of the money contract. So what this means is that even though the stock could potentially make the move back up and break your level and continue further up, you could still potentially be down because the delta is not reacting as much and the theta already worked against you. So this is why on Thursdays and Fridays, if you do purchase out of the money contracts, you're going to see a lot more volatility in that out of the money contract on that premium price as the stock continues to move up, retest, move up, retest. You're not going to see it as much as in the money or at the money contracts. That's why I recommend when you're trading Thursdays and Fridays, especially Fridays, and you're trading 0-day expirations, what I always recommend is to buy slightly in the money contracts. These are going to be less sensitive to price swings in the underlying stock, with whatever stock that you're trading. It's going to be less sensitive to the delta, less sensitive to the theta, and you're going to have a higher probability chance of becoming profitable on an in the money towards the end of the week versus an out of the money and at the money. So now if you buy yourself some time, by a week out, your contract is less sensitive to those price swings. It's not going to be as volatile. It's always safer to buy a week out expiration, no matter what type of trading strategy you have applied. The safest trades to take are a week out. I personally trade same week expirations Monday, Tuesday, Wednesday, and Thursday. On Fridays, I do sometimes trade 0 days to expiration. Sometimes I buy following week. It just depends on what the market is showing me. But the safest trades to take, especially if it's Thursday or Friday, is to buy following week expiration, especially if you're a newer trader. It is a little bit more expensive to buy following week expiration or third week expiration, but you're going to limit your risk a lot when you do that, especially towards the end of the week. Alright guys, so it's it for today's video. Thank you so much for watching. If you like the video, don't forget to give it a thumbs up and subscribe to my channel. And if you have any video suggestions or any comments about the video, you can go ahead and comment down below. And yeah, I'll talk to you guys in the next video. Bye!